How do you set up an offshore structure for U.S. entrepreneurs? Most people think that these sort of tax breaks are only for the rich or the Googles and Apples of the world. But if you're an international entrepreneur, even if you're a U.S. citizen, there are ways to optimize your tax situation. I'm Vincenzo Villamina, CPA and founder of Global Expat Advisors, and I've helped countless international entrepreneurs optimize their tax structure, leveraging the laws and the rules on both the US side and the international side that are available to them. So let's get into it. Looking at this example, what you see somebody who's just a single member LLC owning $140,000 net profit. They live outside the United States. Okay, what ends up happening? They get basically the first $110,000 tax-free underneath the foreign earned income exclusion. Okay, but the rest of that 140K or so is subject to 15% self-employment tax, as well as that 28% tax on anything above that foreign earned income exclusion, which is roughly $30,000. Okay, so in total, between the 15% Social Security self-employment tax and that extra piece that's taxable in the United States, they're paying a total of $30,000 in taxes. Now, let's say this single member LLC entrepreneur all of a sudden switches to an offshore structure. So what happens? Again, they take that $100,000 salary, $110,000 salary. Again, subject to the foreign earned income exclusion, it's tax-free in the United States. However, because they are earning salary from a non-US company, they are not subject to any type of Social Security and self-employment tax. Then what happens after that? Of course, there is a tax on anything over that $100,000, right? Roughly $40,000 of net profit. If you look at the structure where you have a C Corp that owns a foreign company, where that foreign company is in the BVI, Hong Kong, Cayman, what have you, it is subject to a 10.5% GILTI tax rate in the United States if it is owned over 50% by a US citizen. So it's what's known as a controlled foreign corporation. So what happens? Again, that $40,000 net income is subject to this 10.5% tax rate in the United States. Fine. And then let's say they want to take out all the money. They take out, again, the $100,000 tax-free under the foreign earned income exclusion, and then the additional $40,000 is a dividend, which is subject to 15% tax. So in total, they are paying $10,000 tax, as opposed to the previous situation where they were paying $30,000. So what do they need to look out for? It needs to be an international company. They cannot reside in the States. They cannot have any management in the States. They cannot be managing from the States. They cannot have any US employees. They can't have any offices, any warehouses, nothing. That's number one. Number two is it needs to have contractors around the world. It has to have a legitimate functioning business. If it's a one-man shop, it's not going to work. Number three, they have to have business expenses. It has to be a business where they're at least getting 20+% of expenses. And there's a lot more nuances to this. We're just talking at high level. This conversation needs to happen where an analysis needs to be done, and you need to make sure that it is done correctly. But again, these sort of tax savings are available to people if you live outside the United States. And if you have any questions and you want to set up a consultation, feel free to set it up with us at Global Expat Advisors. We'd be happy to analyze and let you know if this situation will work for you.